All right, we are live, sir.
All right.
Ryan, thank you for joining us for another Facebook Friday. Man, it's been a couple weeks again, and last week we had some technical difficulties, which always makes for a fun day. But it looks like there's been quite a bit going on in the market. So where do you want to start today?
Yeah, well, welcome to fall, right? It's October. We've made it this far.
Yeah, my house is already decorated for Halloween.
You're good.
Yeah,
you're
good to go.
Yeah.
Entering fourth quarter, so this is, when people think that the market is just going to hit the brakes and slow down and nothing is going to sell, and buyers think that now's the time to be coming in and writing low offers, right? Obviously we know that's not the case. You want to touch on a couple things with that real quick?
Yeah, I mean, I know we've talked about it a few times, buyers coming in and writing a little bit low or asking for too much in closing costs. So you can see that in the offers. You can see that property comes on the market, looks good, kind of fits the profile what people want.
Yep.
All of a sudden there's 19 offers and it's like it's not even hit the 24-hour mark. And so it takes a few of those burns for a buyer to kind of go, oh man, I can't do that. I can't keep losing these things. It's not working.
Yeah.
And then they get desperate. They go the other way. And so they go, all right, I'm going to, this house is 400 grand. I'm going to go to like 430 or 440. And they'll find out that there's still resistance there, because sometimes you go a little bit too far. And if you don't have any money in the bank to really make up that gap, if there's an appraisal issue or a concern, you're still going to lose. They're going to go with somebody maybe offered a little bit less, but maybe has more cash behind them to go ahead and make up that gap if it should come. And so it's a difficult place for a buyer right now. I mean, it's definitely not an easy process to get your offer accepted. Yeah. And kind of knowing where to toe the line on that, it's really tough. So
for sure, it's difficult for any buyer obtaining financing. I mean, we have clients that are doing like 50% down and offering 60,000 over asking,
right,
and offering the seller to be able to stay in the house for free for a month after closing, right, and still getting beaten out. It's like, really? No appraisal contingency, no inspection contingencies, like short of giving up their child or their spouse, like super solid offers. And man, like it's rough out there. So it's not just the entry level buyers by any means. And especially with the migration pattern of people coming from LA and going north, right? And they've got, when they have the 20% down or more and their appraisals are being waived, like it's fantastic for the seller, but it's super rough for buyers to compete in that environment. And our inventory levels are still silly low. Like, I had somebody text me last night, like, hey, I hear that, we're gonna start building inventory and prices are gonna go down. And I told them, I was like, I haven't heard anything like that, even on a national level. I've heard like internationally that there's some cities that are expecting a cool down. But, I saw something the other day that even the national, it was for last week, the national supply of homes fell another 1%. And they're expecting that come January, like, so they know that typically less homes come on the market now. So when people talk about the market slowing down right now, it's not buyers, and it's not going to be buyers unless something catastrophic happens. The slowdown right now is going to be less sellers bringing their home on the market. And so the national stats were saying that they think that come first of the year, after the insane demand that we have and have had and the low inventory, and then a lack of new inventory, like, and even more of a lack, right, than we've already had this year. They're thinking that nationally, they're going to have less than 500,000 homes for sale at the beginning of the year, which is insane.
Which sounds like a lot. Like if you don't know the stats, it sounds like a ton.
Yeah,
that's a lot of houses.
We have like 125,000 homes in the Antelope Valley.
Right. So putting in perspective, if we were to look right now at the stats, and we're in the low to mid 400s, if I remember correctly, in terms of houses on the market, right? It's low.
If you include like Cal City, yeah. If you get rid of like Cal City and Tehachapi, we're at like 330.
Okay, so under 400 homes for sale in an area that has, like, what did you say, 125,000 homes? Okay, so that's the perspective right there. We have to really look at that. So when we hear as a buyer and you hear the term, well, it's the inventory, it doesn't really register that well. They're like, what does inventory mean? Well, it means that when a house comes on the market, regardless of the price point, could be $800,000 house, could be one at 300,000. There's buyers in all of the various classes that are looking at these things. For every one of those homes that comes on the market, you have minimum 5 to 6 buyers ready for that specific home.
Minimum.
And if it's the best one that just came out of the small group of homes that fit that same criteria, guess where all the buyers, they're all flocking. It's like watching, little kids play soccer.
Yeah.
Oh, new listing pops up and you got like 30 people that run over to the soccer ball and they all start, kind of winning. Yeah. Only one of those lucky kids is going to run away with the ball, right? It's not like all of them get a free ball. One of them gets it. That's what it's like to be a buyer right now.
For sure.
So you have to recognize that, and you can't get frustrated. We've seen people that are like, throw their arms up and like, oh, I'm done. I'm not going to do it.
Yep.
Well, then they're the boomerang client, because what happens is they leave. And when we tell them, okay, and they're like, oh, we'll come down when it cools off a little. After the election, we'll come back. They need a place to live.
Yeah.
Their current place isn't working out.
Yeah.
They go out and they start looking for rentals. And they're like, well, we'll try to find something for 6 months. They get sticker shock when they see the rental price and they're going, oh my God, we don't want to pay that. We're just wasting money. It's so much, it's terribly expensive.
Yeah.
And they need first and last and security. It's actually almost the same amount of money as it would cost me to just move into a property. Yeah. So they end up coming back and they go, all right. What do I got to do to get my offer accepted?
Yeah.
Like, well, you can write those, beautiful letters and take a picture of your family, like right in front of the house. Like, hey, we're super cute. We love this house.
Yep.
Maybe it helps. Maybe it doesn't. You got to just get in there and be aggressive. You got to lead with what you want to buy the house for, your best offer. You can't try to wait and see if they'll counter back and we go in 5K low and then see if they'll counter back. Maybe we'll meet in the middle somewhere. Mm-mm. Go in with your best case. This is what we're offering. And if it works, great. And if it doesn't, you just got to get aggressive and try to find another one and be ready. The minute you see one, you got to be ready to do it. So all those other buyers are doing the exact same thing. They're hanging out for weeks waiting for the right property to come on. When it comes on, I mean, it could be like 9 o'clock on a Friday and they're hitting you up going, write the offer. Yep. I haven't even seen the house yet. Write it. Yep.
Yeah, it's crazy. And to kind of put that in perspective for buyers. So far this year, it's almost 29% fewer homes come on the market. So almost a third less homes to come on the market. But the number of homes to sell is only down 12.5%. Mm-hmm. So, right, that's a huge difference. Like the 12% is not a big deal when we look at, we've had a third less homes available to sell. Even with that, like we could have a huge upswing in, homes come on the market right now, miraculously during the fourth quarter, we'd be fine. So average for us is about 1,700 homes on the market at any given time. We're at 300. So we could more than 5 times, we'd have to, 6 times our inventory to go back to a balanced market. Probably not going to happen in the fourth quarter.
You totally double what we have right now. And you think, oh man, that's going to really have an impact on prices. It won't. There's an absorption rate that we're at right now where you could double the inventory. Yep. And we'll be able to absorb it just fine. Yep. Without an impact on the value of the home. Down the road, let's say, let's kind of play out a scenario for somebody that says, okay, housing's going to drop like after the election, regardless of who wins, housing's going to fall on its face. So why? What would be the precipice? What would trigger that particular event? Well, it could be, rates would have to go up very fast, like overnight, which could potentially happen if you have too much in inflation, right? If inflation starts to rear its ugly head and the Fed stops buying mortgage-backed securities, which are keeping the rates low, and they jump from the upper 2s into like the upper 4s, still historically good, but they'd be considered very high, and it's going to take a lot of the buyers and put them on pause for a minute. Doesn't change the rent price. Right? It's like the landlords are still going to get whatever they want to get for those things, unless there's a ton of rentals on the market. But do a search for that. There's not, like, if you want to rent a 3 or 4 bedroom house in West Palmdale, you got like 3 houses to look at.
And the minimum is $2,200.
Yeah, there's like nothing to choose from.
And if you want a pool, it's going to be like $3,000.
So when you look at it, that market has to shift. And then we also have to shift, rates have to move up, which puts people on pause. You got to get a ton of people going, oh, the market, it's falling out. Let's get our house in the market. So you got to get flooded with homes.
Yeah.
So when the market was nasty back in like 2008, it was flooded with homes. The inventory, the time on market from the moment that a house hit the market before it sold, it was 12 to 18 months.
Mhm.
Right now, it's less than a month.
Yeah.
So we got a lot in a healthy market, it's like 6 months. So
Yep.
got a lot of room to kind of get caught back up before it would really have a drastic impact. And really, honestly, if let's say rates ticked up a little bit and housing prices went down 5% or 10%, your monthly payment's much higher than it is today.
Mhm.
So is that really that much savings? If you were to project that out over time, it's really not. So that the lower rate environment is fueling the fire, right? And then you have these lack of homes. People are like, oh, I don't really feel like moving right now. I'm not going to sell my house.
Yep.
Not very many houses coming on the market. Combine those two, it's just a wildfire in terms of activity for buyers. It's
What are wildfires? We know nothing about that here.
we know nothing about wildfires. Yeah.
Well, and then the other, unforeseen, part of COVID has been the people that are exiting the major metropolitan areas, like people leaving Los Angeles in record numbers. Not that they're probably even declining in population, right? But people are getting out of there and just as many are going back. But we've talked about this several times about where secondary markets or vacation markets like Big Bear, Mammoth, Tahoe, right? Those places are quickly becoming primary housing markets for people who can now telecommute. Nobody saw that coming. And we're a smaller scale of that, because we're already a bedroom community. We have more than 100,000 people that commute to LA to work. And those that don't have to do that anymore, that are here, great. That's, decongesting our freeways, but the people who are closer to LA and no longer need to be, they're moving out. And so we're seeing places like even Neenach is just exploding as far as demand goes. I mean, there's houses out there that are getting, 5, 6, 10 offers on them. There's been a few out there to sell for over $700,000 in like the last month. And never before in my career have I seen that, unless it was on massive amount, like hundreds of acres. These are 5 and 10 acre houses and selling over 700 grand. So interesting to see that dynamic shift. And so we have that increased demand in population here on top of the shortage, on top of low interest rates. It's just been insane. So we would have to have some major things happen to cause the market to slow enough to cause prices to come down.
So to that point, it gets me kind of thinking about this. I mean, just kind of thinking out loud.
Mhm.
Because at first it was a theory that you're going to have places like, people in LA that are in, tighter quarters, apartment living, that kind of thing. And they want to live into, areas that they can get a house. They want to go move into having their own yard because they can now telecommute. And so for a minute there, when that started coming out, and they were saying that was going to be this growing trend, I kind of listened to it and I said, I can see how that could happen, but I don't know that it's a trend. Like maybe it's just like a spike because of COVID, right? And then it all kind of goes back to just kind of being the norm, and you kind of live in the city and you live outside of the city. It's actually showing trending that it's really happening. And I can tell you from clients that have, we have people that are moving from like Newberry Park, which is a great area. I mean, it's not a bad place to live. It's a really nice place to live. Saying, you know what, I don't want to be here anymore. My employer basically last week told me that we can work remote forever. Like they're not going to come back and change it. Just their job type is okay, remote. They're moving to Tehachapi.
Yeah.
Why do you want to go to Tehachapi? Oh, we just want to be out, want our own little space. We just want to be out of the hustle and bustle of everything. Interesting. Okay. Yeah. Kids, like this couple here had kids. So I said, well, what about your kids? What are you going to do with school? She's like, oh, don't worry about it. We've already been on this, kind of like Zoom-based distance learning kind of thing with a Christian school. And they said, we're just going to carry on that way. We just don't feel like, throwing them back in. Well, when everything opens up, we'll probably, work with some of these small groups for meetups and things like that, just for social, but that's it. So I thought to myself, okay, well, that's, it's one client. And then it's like a couple days later, we get somebody else and they're doing the same thing. And we're like, so maybe there is something to this. And so let's say that things do kind of shake up a little bit. We see some resistance on housing prices, maybe in like Los Angeles. But we actually may, this is the total opposite of what we've always been.
Yep.
Housing market kind of shifts. People that are commuting, they're like, I'm not commuting anymore. Value's no good in Allen Valley. That market, our market, AV, drops like heck. And then everybody just kind of stays put in Burbank and Glendale and all that, right?
Yep.
I think we actually may see a little bit of a shift that way. Those markets may soften a bit. If you don't have to make that drive or commute to go back, you stay put. If you stay put, keeps this market, a little bit more elevated.
For sure.
I don't know if you've seen or noticed, but the price points, like the higher, so in our market, a $400,000, $500,000 house used to be kind of that high end or more high end house, right?
Yeah.
Now it's kind of that median house, like the lower end's like 3, and then median in the 5 range, and then you've got the higher end a little bit above that. And they all have buyers and they're all busy and they're all pending right now. It's very interesting to me to see we still have enough demand even in the 500 plus.
Yeah. Yeah. It's so in the, so the bulk of our market is between 300,000 and 400,000. But that number is down over 5%. And then the next bump up is between 400,000 and 500,000, and the number of homes to sell year to date on that is up over 26% versus last year. And then the number of homes that are over 500,000 are up 32% over last year. So you're right. And then like looking back, the 2 to 250 range, which last year would have been, there was more of that available, right, is down 43%. And it's not because people don't want those houses, it's because they don't exist anymore. Like the floor has come up for sure.
Sure.
Yeah, it's really interesting to see that happen. Anyway, so I think that we've made our point on that. What else is going on in financial markets? So how I think I saw that the 15-year loan rates dropped again. Is that accurate?
Coming down a little bit. Yeah. I mean, they're talking a little bit about the short-term and long-term bonds, I think is what you're probably hearing. That's the difference there. So the spread between those, the gap is widened just a little bit. For a while there, they were pretty compressed.
Yeah. So
for a minute, a 15-year loan, a 20-year loan, and a 30-year loan were within like an eighth of each other because they were so compressed on that.
Mm-hmm.
The one thing that I could say could be a problem with that, again, going back to inflation, is just understanding how inflation really impacts bonds. So if let's say I was the bond holder and you decided you're going to give me 10 grand, and I go, all right, I'll give you this 3% return on your 10 grand, and you're like, that sounds great. Well, I'm going to guarantee that for the next 15 years. That looks good for me right away. I get 3%. I know I'm going to make my money. But if my 10 grand that I just got from you and I go to use it for goods and services, doesn't buy as many hamburgers anymore.
Yeah.
Right. You could get, if I got 10 grand, I got, 5,000 hamburgers. Now I can only get 2,000 hamburgers with it. Then I'm actually losing money by lending that to you at such a low rate. And so that's the reason why we see those interest rates start to kind of spike up a little bit due to inflation. So anytime we get a little bit of Fed speak about maybe inflation kicking up or any of that, it's going to make a move on these rates, which they'll still be low. They'll still be record lows.
For sure.
They'll be off the current pace just a little bit.
Yeah.
And I think the markets get really, really volatile, especially as we get closer to election time.
Mm-hmm.
People get spooked. So I think from a refinance standpoint, I wouldn't wait. I've had people, say, I'm going to wait till the election, then I'm going to refi. What really is going to change at that point? Is it really going to get that much lower? I don't think so. No. I think if anything, it's got to go the other way. They got to start to back off, and they used to have a thing called quantitative easement, where they started to kind of back off their support. At some point, they'll do that again.
Yeah.
When that happens, I think we're going to be in for a little bit of a rocky situation for rates.
Yeah, for sure. And so that kind of rolls it with quantitative easing, right? That rolls into there's this next stimulus package that they're talking about doing. I think I saw it was like $2.6 trillion.
With
And
the
that's on,
T.
yeah, with a
Yeah,
T, yeah, because M's and B's are no longer worth anything apparently.
apparently.
And then we've already had the one huge, stimulus package that went through, and it worked. I mean, talking to clients that, work in the car dealerships, and they're saying they're having record months because, and saying that most people's down payments on those cars were those stimulus checks, right? So that it worked, it served its purpose. Hopefully it keeps, the house of cards from coming down, right? The problem is I don't think that people understand that that's not free money. Like, we're gonna have to pay that back. And how are we going to pay that back, and when, and what impact is that going to have on housing? So we know it, surprise, it's going to be a tax, but where is that tax going to show up? Is it going to be an increase in sales tax? Probably not, because that's, state to state, county to county, even city to city, right? And if one place jacks it up too much, you'll see people leave. Is it going to be an income tax outside of whatever changes happen with the election, right? Like, if it's going to be a state income tax, again, I think if it's too much, people will leave. Is it going to be a property tax? Most people think that that would be the best answer. I don't imagine, well, hopefully the government learned from the mistake last time that it won't be a property tax, because when we went through all of those foreclosures, property taxes didn't have to get paid by the banks. The county ate that money. And so that's not the safest place to put it either. Income tax is probably going to be, on a federal level, that's probably going to be the easiest way to recoup that money. And if you're paying more in taxes, that means you're making less money. It means you qualify for a less expensive home, right? And it just goes from there, and home values come down, right? That's going to be really interesting to see play out. Do you have have you heard anything? Do you have any
I think
thoughts around
unless the shift, so if you make a shift to producing again, right, to getting things kind of rolling, to start making our own product versus relying on all this import, that could be the shift. And that might be where most of the money is actually, because if you can keep it here and you can make some, it sounds crazy, but if you make some tax benefits for large scale businesses, so they don't have to go offshore, they don't have to go and hide their money in another country or something like that, like an Apple or various big huge companies that have a lot of money parked in different countries right now, then that's probably going to swing the needle a little bit more than taxing you or I a little bit extra money, 3% here or 4% there to try to recoup it. But who knows? I mean, trillions, it's a ton of money. So you got to really pick up the pace on that a lot. I mean, that's going to take a lot of repayment at some point. The deficit's already huge anyways, right? It just keeps getting bigger and bigger and bigger. And it's the whole compound effect, with the deficit. When I was a kid, I remember hearing the numbers and I was like, wow, that's a ton of cash. And then you look at it now and you're like, oh, that's a whole lot of cash. Like, it's even more.
Yeah.
So where that ends, who knows, but I think what you have to do is you play offense. You kind of create a plan for yourself, regardless of what direction things kind of head. So, if the office changes hands or it doesn't change hands, then what is your approach as a household unit? That's what you have to figure out. So I need to know if one scenario happens, what do I do? How do I come out ahead of that? And if the other scenario happens, what do I do? What do I come out ahead? And don't complain about the results. Look for the opportunity in there. There's always going to be opportunity. Yeah. Somebody, I'll be one of them, that looks for it and says, this is where I'm going to make a bunch of money.
Yep.
Because this is the opportunity in this environment. And we're going to have to shift at some point during that. But you can protect yourself too, and your money that you have in your 401ks in your house and things like that, by paying attention to these things. But you need to know what your plan is going to be to take advantage of situations, because there will be some opportunity at some point down the road.
Of course. Yeah. Yes. Yeah. And so focusing on, that's kind of a bad habit on working your way out of situations, but preparing for an opportunity that's not a bad habit. That's
Mhm.
right. Luck is when preparation meets opportunity and action is
Yeah.
taken. So yeah, that's good. All right. It is 11:30. You have anything else that you want to throw on there? Any closing thoughts?
I don't think so. I mean, just in terms of, where the market's been recently or what we've seen, there haven't been a lot of like crazy loan changes or guideline changes or anything. We're seeing a little bit of relaxation on a couple of guidelines here and there that got a little tight, during this whole pandemic, but nothing like crazy to speak about. It just maybe impacts a few loan cases here and there. The volume is still very, very heavy. And as we end this year, you have to kind of get ahead of that. So I think from a refinance standpoint, expect longer term times. And then also on the purchase side too, I think purchases are going to be, even though they're prioritized, they're still going to suffer a little bit, maybe take a little longer. You can hire, as we were talking at the corporate level today, we can hire as many people, as many processors as we can, as many underwriters as we can, but they all funnel to a closing department. They funnel to an escrow officer that's trying to get this thing funded.
Yep.
And so it's kind of like if you're on the freeway and you got a 4-lane freeway and you're in the carpool lane, which would be like our purchase business right now. We're trying to get a little priority on that. At some point down the road, we know that it's going to funnel down to like 1 lane because there's some construction ahead, right? So yeah, I think you just have to anticipate some of that going into it.
Yep.
Also, as a buyer, if you're pre-approved and you're like, oh yeah, my lease is up in November 1st, I think I'm good. You need to start thinking about some extension time on there, because we know it's not just taking people a week to get their offer accepted. Some people are spending months because of that multiple offer situation. They got to prepare for how long it takes them just to get the offer accepted and look and find the right house.
Yep.
And then they escrow to close it. So you've got a while, in my opinion.
Yeah. And then, so real quick, we were talking about wanting to do that before the end of the year, right? And the Fannie and Freddie, the 0.5% fee on the new loan origination, is that still, was it December 1st? Was that the new date?
So it's for loans that are basically being purchased by Fannie or Freddie or being endorsed by Fannie and Freddie after December 1st. And so it's probably almost everybody's rate sheet right now.
Yeah.
And the reason why is because it's going to take us, I can't just close a loan in 2 weeks these days. Sometimes on these super fast ones, maybe they fly through, but most of them are going to take a little time. You got to package those, you got to get them to Fannie Freddie. So they're not going to take risk on the ability to get those delivered and then have this 0.5 point hit. So banks are putting them in the rate sheet right now.
For sure. And and again, like for the listeners, it's not when that loan closes. Like your loan doesn't have to be closed before December 1st, because the lender has to sell that loan. It has to transfer hands on the back end. And as we discussed last time, that could take a month or so to happen. And so right now, if you write a loan and let's say it's 30 days, that puts you November 1st. And if it takes 30 days to offload it, it's December 1st. Those fees are going to be there. So hopefully people didn't drag their feet.
One more thing too, is we head into the holidays. Oh, go ahead. I'm sorry.
No, I was just saying, hopefully they didn't wait too much on, the election and get to pay 0.5 point because of it. Anyway.
Right. Yep. I was going to say with the holidays too, these months, not so much in October, but as we head into November, December, these are the months where the recording dates are really compressed. Where there's holidays kind of built in, where there's, parties here or people are out. So on top of everything else that we got going on with all the volume that we have, we're also going to have some very, very tight timeframes that are coming up. And so it's really important, I think, if you're a buyer or you're doing a refinance, make sure you're as accurate and complete as possible on the paperwork up front. It makes the loan go through that much faster, because what you don't want to do is sit in underwriting for a week only to find out you need like a dozen other things when you could have probably got that to them ahead of time and been cleared to close and go. So just a couple of tips for you on that.
Yeah, be prepared going into it. What? So, all right, cool, Ryan.
Yeah.
Thank you, sir. Until next time.
All right.
I had a couple of people message in to me asking questions. I think we'll need to address those in the comments in a minute because I have to run. But go ahead and feel free to check those out. And if you guys have any other questions, feel free to drop them in there, or as always, reach out to us directly. All right. Thank you again, Ryan. Have a good
All right.
one. Talk to you
Sounds
soon.
good. Thanks, guys.